The envelope was certified. That's how Marcus knew it wasn't good. He stood at the mailbox at the end of the gravel drive, engine still running on the truck, and read the return address twice. Department of the Treasury, Internal Revenue Service, Austin Compliance Center. Inside, the letter was short. Notice of examination. Tax year 2021 is under review. Your return has been selected for audit based on depreciation deductions claimed on Schedule F. You are required to provide the following documentation within 30 days of this notice: equipment usage logs for all farm machinery, depreciation schedules and calculation worksheets, invoices and proof of placed-in-service dates for all assets claimed under Section 179 or bonus depreciation, field records showing acreage farmed and crop allocation by equipment. An examination appointment will be scheduled upon receipt of requested documents. Marcus read it twice more. Then he folded it, slid it back into the envelope, and drove up to the house. His wife, Sarah, was at the kitchen table with their bookkeeper, reviewing seed invoices for spring. IRS, he said, dropping the envelope between them. Sarah's hand stopped mid-note. The bookkeeper opened it, scanned, and set it down slowly. 30 days, she said. Marcus nodded. He had 30 days to prove he hadn't built his growth on paper. 3 years earlier, the JD dealer had made expansion sound inevitable. Marcus had been farming 1 to 100 acres, half owned, half leased, with equipment that was functional but aging. A 6420 that burned oil, a 9560 combine that needed bearings every season, a 4440 that still ran but had no cab, no air, no GPS. The dealer's name was Glenn. He'd been selling in the county for 15 years, knew everyone's operation, knew their balance sheets better than they did. "You're leaving money on the table," Glenn had said, standing in the shop with a tablet showing Marcus's current setup versus what he could run. "You're at capacity. You can't scale with what you've got." Marcus had known that. He turned down 2 lease opportunities that year because he didn't have the iron to handle them. The Hendricks Quarter, 240 acres of prime river bottom, had gone to someone else. Same with the Morrison lease, another 320 acres that would have tied in perfectly with his north section. "What are you thinking?" Marcus had asked. Glenn tapped the screen. 2 8R 3 appendants, one for primary tillage, one for planting and spraying. Upgrade the combine to an S780. That gives you the capacity to take on another 600 acres, maybe 800 if you manage it right. He swiped to a new screen. Here's the breakdown. 8R 310 loaded, $285,000 each. S780 with a 6.1C corn head, $520,000. You're looking at about $1 or no $9 million retail, but I can get you in at $847,000 with the trade-ins and end-of-year incentives. Marcus had done the math in his head. Even with trades, that was more cash than he'd ever spent at once. "I don't have that kind of cash," he'd said. "You don't need it," Glenn had replied. "You write it off. Section 179. Bonus depreciation. The tax code's built for this. You buy it, you deduct it, your tax liability drops to almost nothing. Then you use the operating savings to cover the payment." Glenn had pulled up a spreadsheet. "Look, you made $210,000 last year, taxable. That's about $57,000 in federal tax. You buy this equipment, you deduct $847,000, your taxable income goes to near zero. You save $57,000 in taxes right there. That's almost a full year's payment." It had sounded clean. Glenn had walked him through the financing. 5% over 7 years. Monthly payment of $2,800. The JD financial rep ran the numbers and said his debt-to-income ratio would sit at 2. 1 to 1, well within acceptable limits for an operation his size. The rep had even run scenarios. If Marcus picked up 600 additional acres at $220 per acre cash rent and corn stayed above $5.50, the margins would cover the payments with room left over. Marcus had signed in November. Delivery was scheduled for late December. Before he left the shop that day, Glenn had glanced at the back corner where the old Farmall 560 sat under a tarp. "You ever gonna move that thing?" Glenn had asked. "No," Marcus had said. "Why not?" Marcus had shrugged. "It's paid for." Glenn had smiled. "Yeah, but it doesn't do anything for you tax-wise. Just sits there, taking up space." Marcus looked at the tractor. Red paint faded to pink in places. Narrow front end, wide rear tires, original. The seat was cracked but still held. The engine was a 6-cylinder gas, reliable as sunrise. Inefficient by modern standards but unstoppable. His father had bought the Farmall in 1974, paid $8,200 cash at an auction in Cedar Falls, drove it home on the road 23 miles because they didn't have a trailer big enough. It had been the primary tractor on the farm for 30 years, planting, dissing, mowing, baling, pulling the grain cart. His father ran it until the hour meter hit 11,000, then kept running it because it didn't quit. When his father passed in 2004, Marcus had kept the Farmall. Not for sentimental reasons. He wasn't sentimental about machinery. He kept it because it worked and because it was paid for. If it's already paid for, his father used to say, it can't surprise you. Marcus hadn't thought about that line in years. Glenn had already moved on, tapping his tablet, pulling up financing options. But Marcus looked at the Farmall one more time before they walked back to the office. It sat there solid and quiet, owing nothing to anyone. Tax year 2021 had been perfect on paper. Marcus claimed 100% bonus depreciation on $847,000 in new equipment. His taxable income dropped from $210,000 to $18,000. He owed the IRS $1,400 instead of $57,000. The bank had been impressed. His accountant had been impressed. His operating line increased from $320,000 to $480,000 based on the expanded acreage and improved asset base. Commodity prices that year were strong. Corn hit $6, $20 in November. Soybeans pushed $14, $80 in the fall. Marcus farmed 180 acres, picking up the Hendricks lease and half of the Morrison quarter, and cleared enough to make his equipment payments, cover operating expenses, and even prepay $60,000 in seed for the next season. It felt like validation. The expansion had worked. The depreciation had worked. Everything Glenn said would happen had happened. Then 2022 shifted. Corn dropped to $4, $80 by June. Soybeans fell to $11, $60. Input costs stayed high. Fertilizer, diesel, chemicals, all still elevated from the previous year's spike. Anhydrous went from $620 a ton to $980. Diesel held at $4 on $20 a gallon when it used to sit at $2.60. Glyphosate doubled. Seed corn stayed expensive. Marcus farmed the same acreage, but margins collapsed. He'd budgeted $600 per acre in total costs. Actual costs came in at $790. On 1,780 acres, that was an extra $195,000 he hadn't planned for. His yield was decent, 278 bushels per acre on corn, 52 on beans, but not enough to offset the price drop. At the end of the year, he cleared $82,000, enough to make the equipment payments and cover some operating debt, but not enough to build a cushion. By October, his debt-to-income ratio had crept to 2.8 to 1. The bank didn't say anything, but they watched. And then the letter came. The first meeting was in town, at the IRS field office in a strip mall between a tax prep service and a dollar store. The agent's name was Patricia Newell, mid-50s, gray suit, no expression. She had a binder with Marcus's return tabbed in 6 places. "Thank you for coming in," she said. "This won't take long. I just need to verify a few details about your depreciation claims." She opened the binder. "You claimed $847,000 in equipment purchases for tax year 2021, all depreciated at 100% under bonus depreciation rules. Is that correct?" "Yes," Marcus said. "And this equipment was placed in service before December 31st, 2021? "Yes," Patricia made a note. "Can you walk me through the purchase timeline?" Marcus pulled out his folder. "I ordered the equipment in November, signed the financing agreement on November 18th. Delivery was scheduled for late December. And the actual delivery date? December 28th. Can you provide the delivery receipts and invoices?" Marcus slid copies across the table. Glenn had given them to him when the tractors were delivered. 2 8R3 Hiens, 1 S780 combine, all invoiced on December 28, 2021. Patricia reviewed them carefully. She turned pages, checked dates, cross-referenced something in her binder. She stopped on the second page. This invoice is dated December 28th, 2021, she said. That's when they were delivered, Marcus said. And when were they placed in service? Marcus hesitated. What do you mean? When did you first use them for farm operations? When did they go into the field? He thought back. The tractors had been delivered 2 days before New Year's. He'd spent the 29th in the cab, setting up the GPS, loading field maps, running through the guidance system. The dealer tech had come out to calibrate the auto steer. He'd put fuel in them on the 30th, but hadn't taken them to a field. There was no field work to do in late December. The first actual field work had been January 4th, pulling the disc across the South 80 to prep for spring. Early January, he said. Patricia made another note. So they were not used in 2021. They were delivered in 2021. Delivery and placed in service are not the same thing under IRS guidelines, she said. She pulled a photocopied page from the binder and slid it across. It was from IRS publication 946, highlighted in yellow. Property is placed in service when it is ready and available for a specific use, whether in a business activity, an income-producing activity, a tax-exempt activity, or a personal activity. The equipment must be used for business purposes in the tax year you claim the depreciation, Patricia continued. Not just delivered, not just paid for, used. Marcus felt the floor shift. It was 3 days, he said. The tax code doesn't provide a grace period, Patricia replied. If the equipment wasn't actively used in 2021, the depreciation claim may need to be reclassified to 2022 when it was first used. She closed the binder. I'll need additional documentation. Usage logs, field records, fuel receipts. Anything showing the equipment was operational and used for business purposes before December 31st, 2021. Marcus didn't have those. He'd assumed delivery was enough. Glenn had said delivery was enough. Patricia stood. You have 2 weeks to provide supplemental documentation. If you can't demonstrate placed in service in 2021, we'll proceed with reclassification. She handed him a form. Sign here acknowledging receipt of the examination findings. Marcus signed. That night, Marcus sat at the kitchen table with his accountant, a woman named Rita, who'd been doing farm taxes in the county for 20 years. Rita had a laptop, a calculator, and a legal pad. She didn't speak for 10 minutes. Then she wrote a number on the pad and turned it toward Marcus. $847,000. Original depreciation claim. Grunierun. Allowed depreciation, if reclassified. $847,000. Taxable income adjustment. She wrote another line, $210,000. Or original taxable income, or $847,000. Adjusted taxable income, if full reversal. Or $1,037,000. Ensure new taxable income. Tax on $1,057,000 at self-employment. Plus federal rates. $287,000 minus original tax paid. $1,400. Back taxes owed. $285 and $600. She circled the next part. 20% accuracy penalty. $57,120. Interest. 3 years. AVG 6%. $51,108. Total exposure. $394 to $128. Marcus stared at the number. Sarah stood behind him, one hand on the back of his chair. Rita tapped the pad. This is worst case, she said. If they disallow everything, if there's no negotiation, if you can't prove partial use. What's best case? Marcus asked. You find documentation that shows the equipment was used in 2021, even 1 day, even 1 field pass. That keeps the depreciation claim alive. And if I can't, Rita didn't answer right away. Then we negotiate, she said. The call came 4 days later. Marcus was in the barn, greasing zerks on the planter, when Sarah walked out with the phone in her hand. It's the bank, she said. He wiped his hands and took the call outside. Marcus, this is Tom Feldman. Tom was the ag lending officer Marcus had worked with for 8 years. Good guy, straightforward, not the kind of call unless it mattered. We received a notice from the IRS regarding an audit on your 2021 return, Tom said. It triggered a review on our end. Marcus didn't say anything. Your operating line is covenant-based, Tom continued. One of the covenants is maintaining a debt-to-income ratio below 3 to 1. Based on your 2023 financial statements, you're sitting at 2. 8 to 1 right now. If your taxable income is adjusted upward due to the audit, if depreciation is reclassified, your ratio could fall outside acceptable limits. Marcus did the math in his head. If they reversed $847,000 in depreciation, his taxable income would spike, but his debt wouldn't change. The ratio would breach. What does that mean? Marcus asked. It means we may need to freeze or reduce your operating line until the audit is resolved. Marcus felt his chest tighten. I need that line for spring inputs, he said. Seeds already ordered. I've got $140,000 in fertilizer contracts locked in. I understand, but if the IRS reclassifies your depreciation, your debt load doesn't change. Your income does. That shifts your ratio. We can't extend credit on numbers that might not hold. Sarah was watching him from the barn door. Her arms were crossed. How long do I have? Marcus asked. The audit needs to close, Tom said, or you need to provide documentation that the exposure isn't material. If you can show the IRS that the claim was legitimate, or negotiate a settlement that keeps your ratio in range, we can keep the line active. And if I can't, Tom paused, then we'll need to talk about restructuring. That might mean reducing the line to match your current ratio or requiring additional collateral. Marcus closed his eyes. We have the farm as collateral, he said. I know, but if we restructure, we'll need to reevaluate the collateral value. Land's down 8% from last year. If we're factoring in audit risk, that changes the appraisal. Marcus didn't respond. I'm not trying to make this harder, Tom said. I'm just telling you where we are. Get the audit resolved. Then we can move forward. Okay, Marcus said. He hung up. Sarah walked over. What did he say? They might freeze the line. She didn't ask anything else. She just looked at him. Marcus sat down on the tailgate of the truck. We'll figure it out, she said. He nodded, but neither of them moved. That night, Marcus sat at the table with Sarah and didn't speak. She pushed a mug of coffee toward him. It sat there, untouched, until it went cold. What do we do? She asked. I don't know, he said. She didn't ask again. Rita came back 2 days later with a different folder. I went through your full asset schedule, she said. Everything you've ever depreciated. I wanted to see if there was anything we could reallocate. She spread papers across the table. Asset lists going back 15 years, depreciation schedules, field maps, equipment logs. The Farmall, she said. Marcus looked at her. What about it? It's fully depreciated. You claimed it over 15 years, standard method, starting in 2005 when you took over the farm. No Section 179, no bonus depreciation, no aggressive positioning. It's clean. The IRS has no exposure on it because there's no tax benefit left to challenge. Okay, Marcus said. So? Rita pulled out a county plat map and a field record from 2021. She'd gone through his notebooks, the same ones his father had kept, the same ones Marcus still maintained out of habit. You farmed the home quarter in 2021, right? Yeah, corn. What equipment did you use? Marcus thought. The 8R for planting, the S780 for harvest. What about tillage? What did you use to prep the field in fall 2020 and spring 2021? He frowned, thinking back. I used the old disc, the one that hooks to the Farmall. Rita circled the home quarter on the map. Section 14, Township 89 North, Range 16 West, 160 acres. You dissed it with the Farmall in October 2021 before planting the following spring. That's documented in your field notes. She flipped open one of his logbooks. October 12, 2021, dissed home 160 Farmall, 568 hours. October 14, 2021, second pass home 160 Farmall, 566 hours. Marcus had written those entries himself. He documented everything, same as his father had. Hours, fuel, field conditions, repairs. Not for the IRS, just to know. Rita looked at him. If the Farmall serviced part of your operation in 2021, then the new equipment wasn't responsible for 100% of your acreage. We can reallocate the usage percentages. Marcus started to understand. The IRS is challenging the new equipment because they say it wasn't placed in service in 2021, but the Farmall was in service. It's documented. If we can show that the Farmall handled a portion of your acreage, then the depreciation claim on the new equipment only applies to the acres they actually serviced. She started writing numbers. If we adjust the equipment usage to reflect actual field allocation, Rita continued, we reduce the exposure on the new tractors. The IRS can't challenge the Farmall. It's fully depreciated. No tax benefit, no audit risk. It's invisible to them. She wrote new numbers on a legal pad. 780 acres total. 160 acres serviced by Farmall, documented. Each one has 620 acres serviced by new equipment. Original depreciation claim, $847,000. Adjusted allocation, 91%, 1,620, 1,780. Adjusted depreciation, 91% of $847,000, 770. Depreciation to reclassify, $847,000, 770. 76,230. Revised exposure, the 7,230 depreciation reduction, tax on 76,230 at 27% effective rate, 20,582. Accuracy penalty, reduced 20%, 4116. Interest, 3 years, 6% ABG, 370 Total revised exposure, 28,482. Marcus stared at the number. Rita tapped the page. We go back to the IRS with this. We show them the field records. We show them the Farmall was operational and documented. We show them the usage allocation was split, not 100% on the new equipment. That brings your exposure from $394,000 to $28,000. Will they accept it? Marcus asked. They should, Rita said. It's documented, it's reasonable, and it's honest. You actually did use the Farmall. She closed the folder. The old tractor didn't save you, she said. It just didn't owe anyone anything. Patricia Newell reviewed the revised documentation without expression. Rita had prepared a 12-page exhibit showing field maps, equipment usage logs, and depreciation recalculations based on actual operational allocation. You're claiming the Farmall 560 was actively used in 2021? Patricia asked. Yes, Marcus said. Home quarter, dissing, and some secondary tillage. And you have records of this? Rita slid a logbook across the table. Marcus's father had kept meticulous records. Marcus had continued the habit, mostly for his own reference. Patricia reviewed the entries. October 12, 2021. Dissed home 160, Farmall 460, 8 hours. She made notes. This changes the usage allocation, she said. Yes, Rita replied. The original depreciation claim assumed 100% usage of the new equipment across all acreage. The actual usage was 91%. We're proposing a revised depreciation claim of $770 us, with the remaining $76,230 reclassified to the following year. Patricia reviewed the math. And you're willing to pay the back tax on the reclassified amount? Yes, Rita said. Patricia closed the folder. I'll submit this to the examining officer. If the recalculation is accepted, we can close the audit with a reduced adjustment. What about penalty? Rita asked. Patricia paused. If you can demonstrate reasonable cause, meaning you relied on professional advice and made a good faith effort to comply, we may waive or reduce the accuracy penalty. And if not, then the penalty stands. 3 weeks later, the settlement letter arrived. Audit adjustment summary. Depreciation reclassification, $76,230. Back tax owed, $20,683. Accuracy penalty, reduced reasonable cause shown, $2,068. Interest, $3,722. Total amount due, $26,473. Marcus could pay that. Tom Feldman called the day after Marcus sent the IRS check. I saw the settlement close, Tom said. Congratulations. Thanks, Marcus said. Your operating line stays active. Your covenant ratio is back in range. You're clear for spring. Marcus exhaled. One thing, Tom added, we're tightening standards across the board. If you plan any major equipment purchases in the next 2 years, talk to me first. We need to see the full tax impact before we approve financing. Understood, Marcus said. He hung up and sat in the truck for a minute. Sarah was in the house. He could see her through the kitchen window, washing dishes. He'd survived. He hadn't won, but he'd survived. 2 months later, Marcus heard that Ron Peterson, who farmed 6 miles east, had sold 240 acres to cover an IRS settlement. Ron had expanded the same year Marcus did. Same dealer, same financing, same aggressive depreciation strategy. Ron had bought a full package, 2 8R tractors, an S790 combine, a 2630 display upgrade, and a tile plow. Total package around $920,000. He'd claimed it all under bonus depreciation in 2021. But Ron didn't have an old tractor. When the audit came, Ron didn't have asset flexibility. He didn't have a fallback allocation. Every piece of equipment he owned was financed, and every piece was part of the depreciation claim. The IRS reversed the entire $920,000. Ron's accountant tried to negotiate, but there was no room, no pre-existing equipment, no usage split, no documentation of partial service. The exposure was full. Ron owed $264,000 in back taxes. The accuracy penalty added another $52,800. Interest over 3 years brought it to $310,000. He didn't have it. The bank wouldn't extend more credit. His operating line was already maxed. The only asset he had, free and clear, was the home quarter and an adjacent 240-acre parcel his father had left him. He sold the 240 to a neighbor for $1 million. Prime ground, river bottom, appraised high. After paying the IRS, the penalties, and the interest, he had $79 million left. He used $2 million to pay down the equipment loans and restructure with the bank. He still farmed, but he was smaller now. Down to 100 acres, 1 combine, 1 tractor, no room for error. Marcus didn't talk to Ron about it. Neither of them did. But word got around. In farm country, everyone knows everyone's business eventually. At the co-op, guys talked. At the grain elevator, guys compared notes. The IRS was hitting hard on 2021 returns. Anyone who'd bought big iron and claimed 100% bonus depreciation was under review. 3 other farmers in the county got audit letters. 2 settled. 1 was still fighting. Glenn, the JD dealer, stopped by the shop in April. He didn't stay long. "Heard you came through the audit okay," Glenn said. "Yeah," Marcus said. "Good, that's good." Glenn shifted his weight. "A lot of guys got hit," he said. "IRS is cracking down on bonus depreciation, targeting farms that expanded in 20 and 21. Marcus nodded. "You still moving iron?" he asked. "Not like before," Glenn said. "People are nervous. They're running what they've got longer. Cash sales are down 60% in the region." Marcus didn't say anything. Glenn looked at the old Farmall, still parked in the corner. "You know," Glenn said, "I should have told you to keep a couple old machines around, just for flexibility." Marcus wiped his hands on a rag. "Yeah," he said. "You should have." That evening, Marcus's son, 10 years old, starting to understand the farm, walked into the shop while Marcus was changing oil on the planter. "Dad," the boy said, "why didn't the IRS care about the old tractor?" Marcus looked at him. "What do you mean?" "The Farmall. They didn't ask about it, right?" "No," Marcus said, "they didn't." "Why?" Marcus set down the wrench. "Because it's already paid for," he said. The boy thought about that. "Is that good?" "Yeah," Marcus said, "it is. Expansion can make you bigger, but being paid for is what keeps you standing."